Welcome to Have an IPA with a CPA. We're here to share ideas to help you and your business make more money and keep more of the money you make. Hi, I'm Robyn Pye.
And I'm Paul Mueller. Robyn and I are CPAs and owners of Mueller, Pye & Associates with offices in Northern Colorado and Katy, Texas.
Today's topic is about the Qualified Business Income Deduction as it relates to rental real estate. Such an important topic for many of our clients, so we hope you'll find this information useful too.
But Robyn, let's first talk about beer.
All right.
We're at Grimm Brothers Brew House in Loveland, Colorado. This is the original craft brewery in Loveland. And today we're sampling their Little Red Cap beer. This is their flagship beer, and what makes this beer so unique is when they took this beer to the Great American Beer Fest. In the first year they opened, they captured the gold medal.
Wow, impressive. Let's
give it a try. Cheers.
Cheers. It's good when it hits your lips.
It's very good, and it's one of my favorites, so I love it. Yeah.
Okay, so let's remind our viewers about the Qualified Business Income Deduction in general. So it's 20% of profit from the flow-through business. The deduction is taken on the owner's personal return, so it essentially converts 20% of your profit to tax-free income. Different sets of rules for a qualified trade or business or a specified service business.
And if you want more information on the Qualified Business Income Deduction, be sure to check out our YouTube channel where we have a video that really does a deep dive on that particular topic. But today we're going to focus on how those rules could potentially apply to rental activities. This has always been a big unknown for us because at the last minute, when Congress passed that tax reform bill in December of 2017, they stuck in a provision that said if rental activities rise to the level of a trade or business, it could qualify for this 20% deduction.
And what does that mean? What rises to the level of a trade or business?
And that's been a big unknown, and it's what you and I have wrestled with because take a situation where a client has maybe a 180-unit multifamily apartment project. They've got employees, they've got a resident manager.
That's probably a trade or business. I don't think that's an issue.
I think that would be a slam dunk. But contrast that with the person that has just a single rent house.
Yeah.
And that could be a problem. So we really haven't known what those rules.
Yeah.
So the IRS issued a safe harbor in January of 2019, and they created this fictional entity called a rental real estate enterprise, or RREE. It's a new acronym. That could be one. It's easier for you to say that than for me to say that. So what a REE, a rental real estate enterprise, has is you're allowed to put one or more properties into that REE and track that activity. And we'll talk about some of the elements of the safe harbor as to why you might want to aggregate rental activities. One of the items is, though, you cannot combine commercial and residential properties in the same REE.
And as I understand it, this is not an annual election. This is an irrevocable election.
There's an irrevocable election to put a single rental activity into an enterprise or to combine similar rental activities into a single enterprise. And when we get into the safe harbor, there'll be probably a pretty compelling reason for combining these activities.
So what are the elements of the safe harbor?
Oh, there's 3 elements to the safe harbor. That's the good news. Bad news is there are 3 pretty big elements of the safe harbor. The first one is the IRS says each rental real estate enterprise has to maintain a separate set of books and records.
So does that mean everybody has to have a formal accounting system, a QuickBooks or a Xero or something of that nature?
Well, as you and I have talked, the best accounting system in the world is the one our clients will actually use.
So an Excel schedule.
So it could be an Excel schedule. It could be a checkbook recap. It could be QuickBooks, as long as there's some kind of record keeping to track the rental income and expenses. The second element of the safe harbor is that each enterprise has to involve 250 or more hours of activity. Now, what's activity? It's rental activity. So it's things like advertising the property, negotiating leases, verifying tenants, maybe with background checks.
Repairs.
Also includes repairs, supervising repairs, buying materials for those repairs. So it's those types of activities that count towards the 250 hours.
And what I understand when I read the law is that it doesn't have to be activity performed by the owner. So if you hire someone to do repairs,
probably the most surprising element of the safe harbor is it's not a 250-hour test for the owner, it's a 250-hour test for the enterprise. Okay. So if somebody hired a property manager, if you hire a plumber to fix a leak in a bathroom, all those hours performed by third parties count towards the 250 hours, which now leads to the third element, which you've got to keep time records. And those time records have to be contemporaneous. It's not something the taxpayer can create the night before the audit. They have to keep track of these records as they're incurring
So
those
it could be a
services.
bit of a challenge because now you need your property management company to record their hours that they're spending.
You need to know how long
there's some work to be done.
You need to know how long the plumber spent fixing that bathroom leak.
Any exclusions from the safe harbor? Any properties that don't qualify?
There's two exclusions. One is if the property is used as an office and home, which we have quite a few clients that do that, or if the home is a vacation home where it's personal use and vacation use and rental use. That's a vacation home. That property cannot be qualified for the safe harbor. The other one they kicked out, which is very mysterious, is they kicked out any property that's rented under a triple net lease.
But most commercial properties are rented under triple net lease.
Many commercial properties are on a triple net lease arrangement. And so why the IRS kicked that one out, I'm not exactly sure. But they did say that even if you can't satisfy these three elements of the safe harbor, the taxpayer can furnish proof that they are conducting the activities of trade or business. Now, we don't know what that means, but it does open the door that if you can't meet the safe harbor, there might be an alternative way to qualify
And I
for
understand that the taxpayer has to sign a statement with the tax return.
This is perhaps the most troubling element of the whole IRS announcement with this safe harbor is that the taxpayer has to sign a statement attached to the tax return saying they satisfied all elements of the safe harbor. Now,
Signing under penalties of perjury.
Right. You might think, well, signing a statement's no big deal. But when you're signing subject to the penalties of perjury, that raises it to a whole new level.
Yeah. So what does all this mean? Give me a recap.
Well, for somebody that has a single rent house, they're probably just not going to qualify for this. And one of the nice things about the three elements of the safe harbor, people can read that safe harbor and figure out, do they have a chance of qualifying or should they not even try? So a person with a single rent house, probably not worth qualifying. The other thing to consider is a lot of our clients operate their rent houses at a loss. By the time you deduct interest and taxes and depreciation,
matter for them.
It doesn't matter for them. They may not want to even try to qualify for that. The other element is that record keeping is essential if you're going to qualify for this.
All right. Well, this has been great, Paul. Thank you for sharing this information. We hope you found it useful. Be sure to send us an email with any comments, questions, or suggestions for future topics. Also, check out our Have an IPA with a CPA YouTube channel for additional topics and ideas. Until next time,
Prost.